Who was the best CEO of the last 50 years? If you answered Jack Welch, you are in the majority. Welch ran General Electric for 20 years, and the company went from being worth about $14 billion to more than $410 billion. Magazine covers, books, the gold standard of modern management. And yet, there were 8 CEOs who beat him. Not with more charisma or more hours, with one thing. They understood that a chief executive has 2 jobs, and almost everyone does only the first. The first job is operating, product, team, customers, margins, execution. You know that one? You are probably good at it, and that is what all the books talk about. The second job is deciding what to do with the money the operation generates, and that job has exactly 5 options. There is no sixth. Reinvest in the business you already have, buy another company, pay dividends, reduce debt, or repurchase your own shares. To finance it, you have 3 sources: the cash generated by operations, debt, or issuing shares. That is all. 5 decisions and 3 sources. It is called capital allocation, and here is the fact that should make you uncomfortable. There is no course on it at the best business schools. As the book puts it, capital allocation is investing, and therefore every CEO is, whether they want to be or not, an investor. Buffett quantified it with a brutal sentence. A CEO, whose company retains earnings each year equal to 10% of its net worth, after 10 years has been responsible for deploying more than 60% of all the capital working in that business. More than half of your company is built through those decisions, and almost no one studies them. The book is The Outsiders by William Thorndike, published by Harvard Business Review Press in 2012. Buffett praised it in his annual letter that year as an exceptional book about CEOs who excelled precisely at this. Thorndike and a group of Harvard students searched databases for companies whose CEO had decisively outperformed their peers and Jack Welch over their entire tenure. They found 8 in the entire modern history of the US stock market. By the time you finish this video, you will be able to do 3 things. 1. Measure your own management with the correct scoreboard, which is not the one you are using. 2. Build an internal capital market, a minimum rate of return, and an honest ranking of all your alternatives, including your own company. And 3. Recognize the force that will prevent you from doing all of the above and the concrete mechanisms to neutralize it. A warning of honesty before we begin, because we are going to maintain it throughout the video. Several of the book's most spectacular figures exist only in the book. The documents from those companies predate the electronic archive of the US Securities Regulator, and there is no way to audit them today. When that happens, I will tell you. The cases that are verified in the press from the time too. Playbook number 1, the denominator. Before changing a single decision, you have to change the scoreboard. Because the reason most CEOs allocate capital poorly is not that they are bad with numbers. It is that they are measuring the wrong thing. The usual scoreboard is size, revenue, employees, offices, market share, total profit. The correct scoreboard, according to the book, is value per share. And there is an entire world inside that preposition. You can double your revenue and destroy value if, to do it, you doubled the number of shares or burned cash on acquisitions that earn less than your cost of capital. You can cut your company in half and create a fortune. Growth and value creation are not synonyms. They are 2 things that sometimes coincide. Second correction to the scoreboard, relative return. It is not enough to say, we grew 15%. The question is 15% compared with what? Compared with your peers who played with the same hand of cards as you, the same cycle, the same regulation, the same input costs, and compared with the entire market, which is what your shareholder could have earned without you. 3 numbers and you already know whether a CEO was good, their return, their peers' return, and the index. Third correction, cash flow, not reported earnings. Net income is a blunt instrument. It is distorted by debt levels, taxes, acquisition history, depreciation criteria. These 8 CEOs, without exception, optimized free cash flow and let reported earnings move however they wanted. Singleton said it without diplomacy. Our accounting is designed to maximize cash flow, not reported earnings. And from there comes the test you can apply today, the one the book calls the Buffett test. During the period you have been running the company, for every dollar of earnings you retained in the business instead of distributing it, Did you create at least $1 of value? If the answer is no, the money would have earned more in the owner's pocket. It is a harder test than it sounds. The case that demonstrates it is verified in the press from the time. Tom Murphy ran Capital Cities, a company of television stations in small markets. In March of 1985, he announced the purchase of ABC, one of the three major U.S. networks, for $3.5 billion. The asymmetry is documented. The previous year, Capital Cities had generated $940 million in revenue. ABC, $3.7 billion. It bought something almost 4 times larger than itself. And Warren Buffett put up the money by buying 3 million new shares at $172.50 each, $517 million. 10 years later, in July of 1995, Disney bought the combined company for about $19 billion. Now notice the detail almost no one tells you, and which is the entire playbook in one sentence. According to the book, during the years before that purchase, Murphy was not buying companies, he was repurchasing his own shares. He retired close to half the company at single-digit multiples because no business for sale offered him a better return than his own cheap stock, and his shares outstanding fell 47% over 20 years. The denominator. While his competitors grew in size, he grew in value per share. Your common mistake here: reporting growth as if it were performance. Your practical action: calculate your 3 numbers from the last cycle. Your return, that of your 2 most comparable competitors, and the index, and apply the Buffett test to the earnings you retained. If you cannot do it, that is the finding. Playbook number 2, the hurdle rate. You now have the right scoreboard. Now comes the decision. And this is where the book stops being business history and becomes a machine you can install on Monday. The machine is called an internal capital market, and it works like this. First, you set a minimum rate of return, the return below, which you simply do not invest. The book is explicit that this is one of the most important decisions a chief executive makes, that it must comfortably exceed your blended cost of debt and equity, and that in practice it is usually somewhere in the mid-teens or higher. Second, and this is what almost no one does, you calculate the expected return of all your alternatives using the same yardstick. All of them. The plant expansion, the new product line, the acquisition, paying down debt, the dividend, and your own stock. Third, you rank them by risk-adjusted return and demand a higher return from the riskier options. An acquisition should beat a repurchase by a wide margin because integrating someone else's company is far more uncertain than buying your own. And that is where the idea appears that reorganizes an operator's mind. Your own company is a competitor for your capital. If your shares trade at a multiple that implies a return higher than any project in your pipeline, the best available investment is yourself, and the project can wait. The book carries a warning you should post in the boardroom. Beware of the adjective strategic. It is often corporate code for low returns. Every time someone defends an acquisition by calling it strategic without putting a number next to it, they are asking you for faith. The 2 cases. The first is told by the book, and I attribute it that way because the figures from that era cannot be audited today. Henry Singleton at Teledyne spent the first decade buying companies, more than 100, always paying low multiples, with a stock the market valued very highly. Sell expensive to buy cheap. And when the market turned and his own stock was left for dead, he did the reverse operation. Between 1972 and 1984, according to the book, he repurchased around 90% of his company's shares in 8 tender offers. The average multiple at which he issued shares was above 25. The average multiple at which he repurchased them below 8. The same person, the same company. 2 opposite directions, 1 criterion, price versus value. Buffett said of him, in a quote collected by John Train in The Money Masters, that he had the best operating and capital allocation record in American business. The second case is verified in the press and in Berkshire's letters. Bill Anders arrived at General Dynamics in January of 1991, with the Berlin Wall recently fallen and the defense industry collapsing. He did the opposite of what a CEO trying to survive politically would do. He shrank the company. He sold entire divisions, including, and this is documented, the Fort Worth fighter business, the one that manufactured the F-16, to Lockheed for about $1.5 billion. His favorite division. And with the cash, he did not buy growth. In 1992, General Dynamics repurchased close to 30% of its own shares through a Dutch auction, in addition to returning capital to shareholders. Berkshire came in by buying around 14% of the company at about $72 per share. And Buffett did something almost unprecedented. He gave management the right to vote his shares. That is the strongest vote of confidence that exists in the markets. Anders summarized it this way: most CEOs are judged by size and growth. Very few truly focus on shareholder return. Common mistake: approving projects because they are in the plan, without an explicit hurdle rate and without comparing them with your own stock or with paying down debt. Practical action. Write your hurdle rate on a sheet of paper. One number, not a range. And rank your 3 pending investments against it and against repurchasing ownership. If something does not beat it, it does not get done this quarter. Playbook number 3. The institutional imperative. Here is the uncomfortable question. If this is 5th grade arithmetic, and the book literally says these CEOs did their calculations on a single sheet of paper using 5th grade arithmetic, then why doesn't everyone do it? Buffett answered that question in his 1989 letter to shareholders in the section where he reviews the mistakes of his first 25 years. He gave it a name, the institutional imperative. He wrote that rationality frequently withers when this force comes into play and listed 4 manifestations. Listen to them slowly because you are going to recognize your last board meeting in at least one of them. First, as if obeying Newton's first law of motion, an institution resists any change in direction. Second, just as work expands to fill the time available, projects and acquisitions appear to absorb the funds available. Read that again. If there is cash, something will appear to spend it on, not because it earns a return, because it is there. Third, any business whim of the leader, no matter how foolish, will immediately be supported by detailed profitability and strategy studies prepared by subordinates. The committee will not stop you. It will build the justification for you. And fourth, the behavior of comparable companies is imitated without reflection, whether they expand, acquire, set compensation, whatever their peers do. The counterexample is verified with a primary source and is the perfect epitaph for this force. On July 9, 2007, the Financial Times published an interview with Chuck Prince, then CEO of Citigroup. Prince said, "When the music stops, in terms of liquidity, things will get complicated. But as long as the music is playing, you have to get up and dance. We are still dancing." That is the institutional imperative speaking in the first person. I know this ends badly, and yet I cannot stop doing it because my peers are doing it. From January 2007 to March 2009, Citigroup's stock lost around 98% of its value. What are the vaccines against the institutional imperative? The book describes them as structure, not willpower, and that is exactly what makes them usable. First, separate the 2 jobs. Radically decentralized operations, let the person closest to the customer decide, and radically centralized capital, decided by the CEO. Munger called it a strange mixture of decentralized operations and highly centralized capital allocation. And the book's figures on headquarters are almost caricatures. Teledyne had fewer than 50 people in its corporate office with more than 40,000 employees. Berkshire, 23 people for more than 270,000. The book even points out what it calls the building complex, an apparently inverse correlation between constructing spectacular headquarters and the returns that follow. Second vaccine, the one-page sheet. If an analysis does not fit on one page prepared by you, with conservative assumptions, what you have is not analysis. It is a study someone prepared to support a decision already made. Buffett's third manifestation exactly. Third, the checklist, and I do not mean that as a metaphor. The book closes with 10 points. Precisely because a checklist forces you to think slowly when pressure from the environment pushes you to decide quickly. The author himself describes it as a vaccine against conventional wisdom and against the institutional imperative. And fourth, the hardest one, patience with episodes of boldness. These CEOs went years without buying anything, one of them an entire decade, and each made at least one bet that exceeded 25% of the value of their company. Murphy bought something larger than himself. They were not waiting out of prudence. They were waiting because the price did not work. And the day it did, they went all in. The book also reports a scene that sums up the social pressure behind all of this. When the consulting firm of the moment recommended that Katharine Graham stop the Washington Post's share repurchases, she obeyed for 2 years. Her son later called that recommendation the most expensive advice in history. That case exists only in the book, and that is how I am presenting it to you. Common mistake: confusing activity with performance, and letting available cash define the investment agenda. Practical action. Audit your last major expenditure against the 4 manifestations. Did you do it because it earned above your hurdle rate? Or because there was cash, because your peers were doing it? Or because someone brought you the study you already knew you wanted them to bring? Let's close the system because the 3 playbooks are 1. The denominator changed your scoreboard, value per share, against your peers and against the market, measured in cash and not reported earnings. The hurdle rate gave you the decision. 1 explicit number, all alternatives ranked using the same yardstick, your own company competing for your capital, and professional distrust of the word strategic. And the institutional imperative explained why this is difficult and gave you the structural vaccines. Separate decentralized operations from centralized capital, the 1-page sheet, the checklist, and patience with boldness. The honest warnings, which this channel always puts on camera. First, the quantitative core of several cases, especially Teledyne's 90% repurchase figure and the 3-decade returns, exists only in the book. The documents predate the electronic archive and there is no independent source that confirms them. The cases we did verify in the press from the time are Capital Cities and ABC, the sale of the F-16 business, the 30% repurchase at General Dynamics, Berkshire's position and transfer of voting rights, and the Citigroup quote. Second, there is an obvious survivorship bias. 8 winners selected because they won. The book does not tell you how many used aggressive debt and repurchases and disappeared. The arithmetic works in both directions. Leverage and buybacks at the wrong price destroy a company with the same efficiency with which they build one. Third, several pieces depend on their era. Tax regimes, private market multiples, and control structures with multiple vote shares that governance today would examine closely. The system is the discipline of comparing returns. It is not a recipe for copying moves, your immediate action, tomorrow, on a single sheet of paper. At the top, write 1 number. Your hurdle rate. Underneath, list all your capital options for the next 12 months. Every internal project, every acquisition in the pipeline, paying down debt, dividend, and repurchasing ownership in your own company. With the expected return of each using conservative assumptions. Rank them, draw the line at your hurdle rate and delete everything below it. And at the bottom of the page, answer the Buffett test from the last cycle. For every dollar you retained, did you create at least $1 of value? Stop doing 3 things. Approving investments without comparing them against your own company, accepting the word strategic without a number next to it, and letting available cash decide the agenda. The sign that you are already doing the second job is simple. You can name your hurdle rate without looking it up, and you can say which capital option came in second the last time you made a decision. If you know what came second, it is because you truly compared. And the question for the comments, because I want to hear from real operators. What is your hurdle rate? The exact number. And when was the last time an internal project lost to the alternative of buying your own company? Tell me below. On this channel, we turn business books into executable systems. If you decide where the money goes, stay close.